tax in New York. Thank you for joining us today, and we're going to wait here another minute and give folks a chance to log in. I hope it's just 12 o'clock, or 12 o'clock Central Time. I hope you're all having a good day. It's hot and stormy here in Nashville, where I live. But I don't mind the rain because we haven't had a lot of rain here in the last month. Okay, it's a minute after and we'll get started. Folks can join us. We'll make the slides available to anybody that needs them. So that's me, Director of Government Relations for Avalara. Been doing that now for 3.5 years. Prior to that, I spent 7 years as the first executive director of the Streamlined Sales Tax. Then 10 years before that as a director of the Sales Tax Division for South Dakota. So it's in those 17 years where I gained all my understanding of sales tax, mostly from a compliance perspective on the government side, and then from a research and change perspective when I was with Streamlined Sales Tax. Today we're going to talk about New York, and we're going to talk about getting started, what you need to do if you're a new business there or you're getting ready to open up a new business there. What do they tax? What do they exempt? Some of the things about their rates and how you go about the calculation, local taxes, then filing a return and making a payment. New York actually is a relatively straightforward state if you're selling straightforward stuff. And we'll talk a little bit about the one area where they are a little less straightforward. But for the most part, it is a well-managed department. It's called the Department of Taxation and Finance. Long-time employees there, very professional, lots of attorneys and CPAs. They're very very knowledgeable about what they do and very knowledgeable about the sales tax in New York. They will call you a vendor. Regardless of what you call yourself, they're going to call you a vendor. Something that's a little bit unusual, perhaps frankly very unusual, is that you don't get a sales tax permit, you don't get a sales tax license, you get a certificate of authority. And so you apply for this certificate of authority, and that gives you the authority to operate a business in the state of New York. You must have one of these. You can't operate a business in New York without one of these. And if you're selling property or service that are subject to tax in New York, you have to have one of these. If you issue or accept New York exemptions documents, you have to have a certificate of authority. A little bit different than many states. There's frankly a fair number of states out there that don't require registration if you're going to issue or accept exemption certificates in that state. A number of states don't want to have manufacturers and wholesalers registered unless there is some real specific tax collection requirement they're going to impose on that person. New York's a little bit different. If you issue or accept a New York exemption certificate, you have to have the certificate of authority. You must have one of these for every location. 12 stores, 12 certificates of authority. You need to apply in advance. It is against the law to operate a business in New York without a certificate of authority. And they recommend that you give them at least 20 days notice, or not 20 days, that you submit your application 20 days in advance so that they have the time necessary to evaluate your application. If you operate a business without registering and they're in a bad mood, it will result in a first day a penalty of $500 and then $200 a day each day thereafter. So it's important to take their certificate of authority seriously. If you're operating a business, you're open up in a new business, go online. They have one thing I'll tell you about them is they've got an amazing website. It is just full of every little tiny bit of information that you will need to manage your sales tax compliance in New York. Everything that you need is out there. So one more thing, you're a trustee for the tax. They expect you, not expect you, yet they will hold you liable for failure to account for the sales tax that you collect. As a trustee, you are responsible for that, their tax, and you have to remember this, the moment you collect it from their customer, and maybe even before that actually, the moment that a taxable sale occurs, that's the state's tax, and you are the trustee for the state's tax. So, a business is a resident of New York State taxing jurisdiction if it carries on, and now this page is more about the local governments in New York, but it applies to the state of New York as well. If you carry on employment, trade, profession, or maintain a place of business in a jurisdiction, you are a resident of that jurisdiction. If you store property, including vehicles, trailers, and boats, that constitutes maintaining a place of business. So those are the things, when they look at you, they're going to look at you and say, okay, are you leasing trucks in our state? If you are leasing trucks in our state and those trucks are in our state, you have stored that property there and you are maintaining a place of business, and therefore you are subject to our tax. So what do they tax? They are a kind of a, I call these a traditional state, and a traditional applies to how they tax services. They tax all tangible personal property, like all states. Every state with a sales tax has a statute that says all tangible personal property is subject to tax in this state unless specifically exempt. And sometimes they'll have that exemption in that the imposition statute. Sometimes they'll have an exclusion. And there's a rather there's a legal distinction between an exclusion and an exemption. The practical effect is if you don't charge sales tax on that item, there's some other issues that go along with exclusions and exemption. The burden of proof is different on exclusion than it is on an exemption. But at the end of the day, whether it's excluded from the sales tax or exempt from the sales tax, it is you shouldn't charge sales tax on it. So they tax all tangible personal property unless specifically exempt. On the reverse of that, on services, they exempt all services unless they're specifically taxed. So just a few short things about things that they, like I said, all tangible personal property, the sale of gas, electricity, refrigeration, and steam is taxable. Got that in there twice, nice job. Telephone and telephony and telegraphy, the words that they use to describe communication services. Shipping, handling, and delivery are taxable on the sale of tangible personal property or tangible personal property on which a taxable service has been performed. So if you are selling tangible personal property and there is shipping, handling, or delivery on that charge, that is subject to New York's sales tax. The exception is when the customer, your customer, arranges delivery by a third person. And this is rather normal across the country. The states that tax, it's fairly common for a state that taxes shipping and handling delivery to tax that only because you are selling that product and therefore you are, it's all part of the price of that product. But if your customer arranged for the transportation and they use a third party, the state that doesn't normally tax services would exempt that. So let's talk about where they are a little bit unusual. If you go out and you pay attention to the things that are written up about New York, go out on their website and look for rulings that they've had or court cases they've had. You see lots of questions that people, and by the way, they do publish their rulings, their letter rulings. So if you are selling pre-written computer software, there's lots of letter rulings out on New York's website that you can go out and look at, and you might find somebody that's already asked the same question or asked a question with the same facts that you have, and that's what's important, the same facts that you have. And it might save yourself the trouble of giving them a call or writing them a letter. But like I said, you see lots of letter requests on pre-written computer software information services because their statute is a bit dated, and they spend a lot of time trying to answer modern questions, modern facts, modern technology with a rather dated statute. And so you see a lot of those, and sometimes you find rulings that are just a little bit odd. So tangible personal property includes pre-written computer software. That's a fact in every state in this country. Every state in this country treats pre-written computer software, canned software, as tangible personal property, even if it doesn't come on a tangible form, whether sold as part of a package or as a separate component or otherwise, and regardless of the medium by which such software is conveyed to a purchaser. That's a relatively standard way for a state to say canned software is taxable, whether it shows up on a disk, where it shows up on a computer, or whether you download it. That's pretty standard. Not every state taxes it when it's delivered electronically, but this is a pretty standard way of saying it's taxable when it's delivered electronically. So pre-written computer software, taxable regardless of the method by which it is conveyed to a purchaser. Also taxable is the service of collecting, compiling, or analyzing information, the furnishing of reports on the above information to other persons, and the service of storing tangible personal property not held for sale in the regular course of business. So their tax applies to information services, and information services is the service of collecting, compiling, and analyzing information. The service of collecting, compiling, which is the report has to be associated with the service of collecting, compiling, and analyzing, and then furnishing the reports to the people. They have a long series of letter rulings out there that say if it's the customer's information and the customer is out there accessing their own information, that's not an information service. So you have to be in the business of doing the collecting and servicing and storing the information and issuing the reports to them. If a customer is out there hitting your software, your information service, and they're just looking at their own information, that is not taxable. But like I said, this is very complicated, and the statutes are very old, and it's critical that your facts are exactly the same facts as what other people have asked. So what else do they tax? Like I said, certain information services, producing, fabricating, processing, printing, or imprinting tangible personal property furnished by a customer who does not intend to resell it. And an example, individual purchases lumber and has a cabinet maker construct a bookcase for him or her. That fabricating is taxable. Installing, maintaining, servicing, or repairing tangible personal property that is not held for sale by the purchaser. So the example, servicing automobiles, repairing appliances, and repairing radios and television set. That service is in repair or taxable. Storing tangible personal property is not being held for sale. Not being held for sale, and that's a critical phrase in there. Storing property that's not being held for sale. So if you are storing stuff that's being for sale, that doesn't meet this definition. If you have, in their example here, if you have a fur coat that you have stored for the summer, that's a taxable service in New York. Renting safety deposit boxes, of all things. Okay, what services do they? Maintaining, servicing, or repairing real property, both inside and outside. Cleaning, painting, gardening, snow plowing, trash removal, general repairs. Interior decorating and design services. Protective and detective services. Entertainment and information services provided by means of telephone or telegraph. Passenger transportation services with a driver. Limousine, black cars. Doesn't include taxis and bus services. Now, one of the things that makes New York State a little complicated, maybe more complicated than a number of states, is the way that their local governments can treat things differently than the state does. In New York City, in particular, there are a long list of services that the state of New York doesn't tax, frankly, aren't taxed anywhere in the state of New York except in the city of New York. Written and oral credit rating services, credit reporting services, beauticians, barbering, hair restoring services, tattooing services, tanning services, manicure and pedicure services, electrolysis, massage services, sale of services of transporting, transmitting, distributing, or delivering gas, electricity when purchased from someone other than the vendor of the gas, electricity, and I'm going to go into a little bit more detail on that one in a second. Weight control and health salons, gymnasiums, Turkish and sauna baths, and similar establishments. So these 2 pages of services are taxed by New York City. They're not taxed anywhere else inside of the state of New York. And while you'll get the luxury of paying New York's city sales tax on your New York state tax return, you need to know that if you're in this business and you have multiple business, if you're in the business of owning tanning salons in New York State, it's going to be taxable in the city and not taxable anywhere else. Now, just a couple sentences on the sale of services of transporting, transmitting, distributing, and delivering gas and electricity. About 20 years ago, 25 years ago, the deregulation movement started in the gas and the electricity business. And there were a number of folks who wanted to get into the business of distributing gas. They wanted to own the pipeline, or they wanted to own the wire, and they weren't the same people that owned the gas. And the states, at that time, the state tax laws, when they taxed these things, presumed that the owner of the gas owned the distribution facility as well. And when the deregulation movement hit these 2 industries, there were a number of states that had to go out and look at their sales tax law because they taxed the natural gas. But they didn't, at that point in time, they didn't tax the distribution of natural gas. And because there was never an issue because the person that distributed the gas owned the distribution facilities. So when the distribution facilities were separated from the product that was being distributed, states had to go back in and decide whether or not they were going to change their law, because there's a price for the distribution that was built into the price of the gas, and when the states taxed the gas, they taxed the distribution as well. So when this all occurred, and the person that owned the gas wasn't selling the distribution, the price of the product changed, and there were states who had to decide whether or not they were going to accept less sales tax revenue on this area because they were only going to get tax on the gas itself, or the city of New York did decide to impose a statute that taxed the transportation, the transmission, the distribution. Long story for something that doesn't really matter that much. Okay, one area that is quite unique to the state of New York is the capacity for school districts to have a sales tax. There are lots and lots and lots and lots of taxing jurisdictions around this country, 11, 12, 13,000 tax jurisdictions around this country. Very few of them are school districts. The overwhelming of them are cities and counties, and then specially created districts created for unique things, and New York has one of them. But New York is one of those states where the school districts have some authority to impose a sales tax. But they can only tax very few things. Gas, electric, refrigerant, and steam service, telephony, telegraphy, more telephone and telegraph, only except interstate and international, because you only tax intrastate service in New York, and then mobile telecom services provided by a home service provider. So these are the list of things that school districts can tax, and I have a slide here later on that tells you how many school districts do that. It is a little bit confusing if you're in that business, and it is something that you need to be careful of if you are in that business. If you're not in any one of these businesses, then you don't really need to worry much about school district sales tax in New York. Okay, what does New York exempt? Food products, certain beverages, dietary products, health supplements that are sold for human consumption. They exempt groceries. And that's more than half the states in this country exempt groceries. There's 5 or 6 different definitions of groceries out there, and this is New York's definition. And I apologize, I've left the word except out. They tax candy, confection. This bullet there should say except. They tax candy, confection, soft drinks, alcoholic beverages, fruit drinks that contain less than 70% natural fruit juice, sandwiches, and heated foods. Oh, I got the taxable at the end. Sorry. Yep. So food's exempt, groceries exempt, except for the things in that bullet. They exempt drugs and medicine intended for internal or external use in the diagnosis, cure, mitigation, treatment, or prevention of illnesses or diseases in human beings. A very broad definition. They exempt clothing or footwear sold for less than $110 per item. And this is another area where they differ from many states. This exemption at the state level is optional at the local government level. So less than $110. There are, let's see, Rhode Island, Massachusetts, New York, and maybe one other state does this thing where they exempt clothing based upon the value of the clothing, and they don't all use the same value, which is a little bit frustrating if you're in the clothing business, and they don't necessarily always follow the same rule. There's 2 rules in the way that clothing are exempt in the Northeast states. They exempt all clothing sold for less than an item. So in New York's case, all clothing and footwear sold for less than $110 per item is exempt. So if you're selling a shirt, it's $109.90. It's exempt from the state sales tax altogether. If you're selling a shirt for $110.10, it's all taxable. The other way of doing it is that the threshold, the dollar threshold, is an exemption that applies to the entire product. And I'm not right offhand. I can't remember which state does it this way. But what they do is they pick a dollar threshold and they say, okay, the first $175 of everything is exempt. And if you're the retailer, you have to say, okay, I'm selling a shirt for $100. It's under $175. It's all exempt. I'm selling a shirt for $200. The first $175 is exempt. So you know your computer system has to be programmed to say, okay, I've got a $200 shirt, and I need to exempt the first $175 of it. I don't know which one of these, and then I'm not going to get into the fairness business. There was a long time ago, or not that long ago, this was a very complicated thing to program. It's not quite as complicated to program now as it used to be, but it is something that is done both ways. So if you're a national clothing distributor, or even just, frankly, just a regional one in the Northeast, there's 2 different ways of doing it. And then, of course, there's the third way, which is New Jersey, which is exempt all clothing altogether, except clothing with fur on it. New Jersey exempts all clothing, but taxes clothing with fur. Okay, what does New York exempt? Medical. Continue on with that. Medical equipment and supplies. Purchase it for use in providing medical or similar service for compensation. Now, this is the exception. So medical equipment and supplies are exempt, except for those that are purchased for use in providing medical service or similar services for compensation. So if you're a doctor, a medical supply that you buy for your use in your practice is taxable. That same thing purchased by a patient for their own personal use will be exempt. Prosthetic aids and devices, hearing aids and eyeglasses, laundering and dry cleaning, including carpet, drapery, and rug and cleaning services, newspaper, magazines, and other periodicals, shoe repair. So that was a list of things that I went through the list, a couple pages of things that the state exempts. Now we're going to talk about the entities that the state exempts. Who does New York exempt? The United States and its agencies and instrumentalities. New York State and its local governmental agencies and instrumentalities. They have a lot. Normally, in a normal state, you wouldn't see the United Nations listed. You would see diplomatic missions and diplomatic personnel. By federal treaty, no state may tax purchases by diplomats. And so every state has a process by which they document the exemption, or they force retailers to document their exempt sales to diplomats. Exempt organizations such as religious, charitable, scientific, and educational institutions, they have to qualify to be exempt though. They aren't just exempt by statute. They have to complete an application and receive a certificate of exemption from the Department of Taxation and Finance. Certain post organizations consisting of past or present members of the armed forces, the American Legion, the VFW, certain Indian tribes, Indian nations, tribes, or individuals. If you follow New York State tax law, in articles on that, you know that they have a long, long history of disagreeing with their tribal governments inside of New York. Most of it has to do with cigarette taxes, but they also have lots of other areas where they and the states don't agree. And I'll get into a little, there are, when I say certain Indian nations and tribes, there's a list. And by law, just that list, and they're all New York based. Purchased by any other state or country or by an agency or locality of another state or country are not exempt from tax. Many states have what they call a reciprocal statute, and they exempt their own state, and they will exempt any other state if that state exempts their state. And this is an example of a non-reciprocal state. So a state that exempts its own governments would not exempt New York governments because New York does not exempt their governments. So we know it's taxable, we know it's exempt in general. We now need to think about how they administer their exemption. This is the area where most people are surprised and disappointed in state sales tax. Very rarely do people disagree about what the definition of a chair is. You might disagree about whether or not a chair was used in the manufacturing process or not. Reasonable people could disagree with that. Reasonable people could disagree about what an information service is in New York. And that's why when you go down and you look through their list of letter rulings, you see lots and lots and lots of letter rulings about information services, because it's not straightforward, and the state honestly has to look at everybody's facts and decide whether or not those facts are the same as everybody else's facts. Other than information services, New York sales tax is relatively straightforward, but everybody gets caught in the exempt administration. Frankly, which is the case all over the United States. And the biggest problem with exemption administration is having to keep track of the exemption certificates. So a vendor may exempt a purchase from sales tax if the purchaser furnishes a properly completed exemption certificate. Pretty straightforward. And New York has lots of exemption certificates. The certificate must be accepted in good faith. Good, and I'll get into good faith, within 90 days of the delivery of property or indentions of a service. Now, you don't often find that within a specified number of days in their exemption administration statutes or regulations. Normally, that's the kind of thing you see in their audit process. In most states, frankly, almost every state in the country, their presumption is that if the seller doesn't charge sales tax to someone because that person says they're exempt, that the seller gets that exemption document immediately at the time of sale. At the time of sale is the standard presumption in this country when it comes to exemption administration. Over decades and decades of unpleasant audits, states have all developed a practice of allowing retailers additional time once the seller gets a notice of intent to audit. So the standard format in this country is the state expects you to have that exemption certificate at the time of sale. And then 3 years later, when they give you a notice of intent to audit, they'll tell you, and we want to see all your exemption certificates for these 3 months for the last 3 years. And they give you a certain amount of time to get all that done. New York has a different approach. Right up front, they say you have to accept it within good faith, and you have to get it within 90 days of delivery of property or rendition of a service. So they make it clear right up front that if you don't have it within those 90 days, then there's an issue. Good faith means the vendor has no prior knowledge that the document is falsely or fraudulently issued. This is actually a very reasonable definition of good faith. The norm, the standard definition of good faith is that you, the seller, should have reasonably known that your buyer either was not exempt or could not possibly be using that product for an exempt purpose. And the courts, the record of court cases on audits throughout this country are full of cases where the state said, you know he wasn't a farmer, and yet you let him give you an agricultural exemption certificate. You know he wasn't a farmer. Or worse, okay, he's a farmer, but you should have known that he wasn't going to use that thing for agricultural purposes. This is an area where, in my previous job in the streamlined sales tax, there was a lot of work made to try to get states to ease that onerous burden on sellers, to shift the burden back to the person who actually knows the answer, which is the buyer. And so that's in the streamlined sales and use tax agreement. There's a provision that says if you want to be a member of the streamlined sales tax, you cannot punish the seller for the errors or the lies or misinformation provided by the buyer. The states have to go to the buyer to get that information, and they have to go hold the buyer liable for what the buyer said. New York has frankly a very reasonable thing. All you have to do to accept a document in good faith in New York is to have no prior knowledge that it was false or fraudulently issued. So you do not have to presume that you know what that person is going to do with the product, unless you know that they're not going to do it correctly. And I don't know how in the world the state would prove that. So a certificate accepted 90 days after the sale shifts the burden of proof. So if you get the certificate within 90 days of the sale and you can prove that you accepted in good faith, which means you had no idea that it was false or that you had no idea that it was being fraudulently issued, you are not going to be held liable by the state if it turns out that that was an incorrect exemption. Now, that changes after the 90 days. After the 90 days, if you can come in and prove that you took 95 days to get that exemption certificate from your customer, they have automatically, by law, shifted the burden of proof. So it's mutual at that point in time. Both you and the buyer are equally liable for whatever tax might be owed because the certificate wasn't used correctly. So it's really important to get those exemption certificates within the 90 days because it saves your exception from proof of liability. As long as you have within 90 days, the liability and the proof of providing the liability falls on the buyer. After 90 days, it falls on both you and the buyer equally. In addition to that, if it's after 90 days, they're going to make you provide additional documentation. You and the buyer will both be forced to prove, and let's remember how this interaction occurs. They're not auditing the buyer. They're auditing the seller. They're auditing you. So they come in, they see that you didn't accept this exemption certificate within the 90 days, and they don't care. At that point in time, you have to provide the proof that it was a legitimate exemption. They never bother, because rarely do states audit buyers. They almost always audit sellers. Both the buyer and the vendor may be liable for any tax, penalty, and interest if the sale is determined to be taxable. So, exemption certificates are critical. Get them at the time of sale. Get them within 90 days. Make sure they're completed. If you have any idea that this customer is not on the up and up, you should charge them the tax, because if the state finds out you had an idea, they're going to make the argument. They may not win it, but they're going to make the argument that you knew in advance that that person was not using that exemption certificate correctly. So if you're making a sale to a government, the requirement in New York is that you remember New York governments are exempt, U.S. governments exempt, local governments in New York are exempt, and they're exempt by statute. No exemption certificate required, but what is required is that you maintain proof of payment. You maintain in your books and records proof that the entity who you didn't charge sales tax to paid you in government funds, government purchase order, government check, something. You need to have something in your books and records to show that yes, it was the county of whatever it was Albany County, and they were Albany County, and you can prove that because it was a check from the county of Albany. Okay, so let's talk about tax rate and how to calculate the tax. State tax rate is 4%. State uses destination sourcing, both in-state and out-of-state. So if you ship a product from New York City to Albany, you're going to charge the Albany sales tax, and if you ship a product from Rochester to New York City, you're going to charge the New York City sales tax. And same thing if you ship one from Chicago to New York City, you're going to charge the New York City sales tax. Like I said, sales tax is based on where the products are delivered or services are provided to the customer. Many local governments impose a sales tax. Cities, counties, school districts. 27 school districts, to be exact, tax natural gas and propane, the things that they're allowed to tax. Remember when we were talking about their clothing exemption, the $110, and I said that the local governments have the authority to follow the state or not follow the state? Well, very few follow the state. The overwhelming majority of local governments in New York tax clothing. They don't follow that exemption that the state has. Okay. Compute the amount of the sales tax due on a sale by applying the combined state and local sales tax rate at the time of the sale. So add state plus city plus county plus school district. In addition, in one part of the state, there's a thing called the Metropolitan Commuter Transportation District. It consists of New York City, those counties, the Bronx, Kings, New York, Queens, and Richmond counties, and the counties of Dutchess, Nassau, Orange, Putnam, Rockland, Suffolk, and Westchester, which are outside New York City. So this is, and they have an additional sales tax rate imposed by the state of, I think it's 3/8%. In addition, the state taxes motor fuel under their sales tax. And it's a cents per gallon concept. And that cents per gallon method of applying of their sales tax also applies to the Metropolitan Commuter Transportation District. Remember, it's all point of delivery. You add up all the applicable rates, and if you're in those counties that make up New York City and those other counties out there, those are all subject to the MCTD tax. If everything on the invoice is taxable or taxed at the same rate, you compute tax on the invoice. If any item on the invoice is exempt or subject to a different rate, then obviously you would compute the sales tax on each item separately. That's obvious. One thing I found is interesting about New York is that there isn't a specific requirement that you give customers a receipt. I was actually surprised by that because there's a number of states out there where it's mandatory that you give them a receipt. However, if you do give them a receipt, you must separately state the tax. Unless, actually, it was interesting that they have it about any way you want to do it in New York, you can do it in New York. If you have an invoice, you must separately state the tax, unless you have a sign on the wall that says tax included, or your invoice says tax included. So you don't have to give them an invoice. If you do give them an invoice, you have to separately state the tax, unless you have a sign on the wall and a general business practice where you don't separately state the tax, and then you have to advertise the fact that you don't separately state the tax. However you want to do it, you can do it. It's rather an interesting concept. That's really unusual. You don't really see that type of choice in most states. Frankly, in most states, you have to give them an invoice. You have to separately state the tax, and in many states, you cannot eat the tax. You cannot say taxes included. Okay, let's talk about filing a return. Everybody is presumed when you first issue a license, there you're presumed to be a quarterly filer, and so that when you open up a business there, they're going to set you up as quarterly right off the bat. What makes it a little bit complicated is that there is a requirement to go to monthly, and that is when your taxable sales, and this is different than any other state that I'm aware of. If your taxable sales in a quarter exceed $300,000, then you have to go to monthly. You have to go to monthly. This is an obligation on you to make the switch. So the state will eventually send you a notice telling you that you should have been filing monthly, but the law says it's your obligation to know when you're going to exceed the $300,000 and to automatically switch to monthly. Very, very unusual. There are states out there that where switching from one reporting period to another reporting period is done only once a year, and they'll run a report on all their taxpayers, and they'll look to see whether or not how everybody falls out in their predetermined classification of who should file monthly, quarterly, annually. And then they'll send you a letter, and they say effective, on September 1, you're going from monthly to semi-annually, and so on that day you start filing your sales tax return twice a year instead of every month. There's other states that do it on an ongoing basis. You exceed the threshold in February, you're going to get a letter from them in March saying in April you need to start filing differently. New York, you need to watch out for this yourself. Manufacturers, wholesalers, and those who remit less than $3,000 a year in tax are the only ones allowed to file annually. Now, I told you that what's unusual is taxable sales. Most state, actually every state that I'm aware of, the filing frequency is the termination of the tax, not taxable sales. Now, obviously, it's the same thing. When you get to the same, when you do the math, you get the same thing. But in this case here, it's $3,000 in tax to get to annual in a year, $300,000 in taxable sales in a quarter to get to monthly. There's a collection allowance, a very generous one, up to which except it caps out at $200 per quarter. You can file returns on paper or electronically, and you can pay just about any way you want to pay. So I went through New York very high level and very quickly, and I am happy to take any questions. And if it's a question that I don't know the answer to, which is a possibility, we are happy to get back to you on those questions. So Whitney, do we have any questions?
Yeah, we do. Let's see. We sell locally centric packaged food and other non-food products. What are your thoughts on that?
Well, a non-food product, I'm not sure what a non-food product is. I think I know what a non-food product is, but that's very likely going to be taxable. Now, food, if it meets the definition of food for human consumption, and let me go back to that right there. Food products, and certain beverages and dietary foods that are sold for human consumption are exempt from the tax. So if it is something that meets the definition of a food or a food product that's sold for human consumption, then it is going to be exempt. The exceptions are in this bullet right here. And that is, to the best of my knowledge, other than, and I didn't talk about this, but obviously every state in the country taxes prepared food. Every state in the country, if you go to a restaurant, there's a sales tax on that restaurant meal. And I didn't want to get into New York's way of treating prepared food because it's pretty normal. But a non-food product is very likely going to be taxable. If you sell these things bundled, I didn't get into bundle transactions. New York has a pretty standard rule on bundle transactions. The burden of proof is on the seller to decide whether or not the bundle is taxable, and you're likely, once you bundle a taxable thing with an exempt thing, you color the transaction to the point where it could make the whole thing taxable. But I don't have a slide on New York specific things. So I would say that the food items are going to be exempt, and the non-food items are going to be taxable. But I think it depends on who if they're a farmer or someone that meets a farmer definition. I believe New York has a sales exemption for folks like that, but I'd have to look that up. So we need more information about what this person sells, Whitney.
Okay, great. Well, I'll make sure to get their information down for us. We do have another question from someone else. Let's see, you mentioned the penalties for doing business without a certificate. If a client has done this and files a voluntary disclosure, would this penalty of $500 and $200 per day be abated?
That's a very good question. I need to talk to New York about that one. Most states, if you submit a request for a voluntary disclosure, meaning that you're doing business in the state and you're not registered and you're not collecting sales tax, they generally abate most things. I honestly can't think of state that doesn't have a special procedure for those who come in through voluntary disclosure, I mean, the rule is always is the same in every state. If the state finds you, all bets are off. If you come to them voluntarily and say, "Oops, I've been doing something bad," then then things are different. And all of them have a process in place that determines what penalties and interests are going to waive, and it's always a fact-driven decision. But I need to know. Let me contact New York about the failure, the penalties imposed for failure to be registered, because that might be different. Generally, if you come in and you're going to do a voluntary disclosure, the penalties it's usually talked about are the failure to file penalties. You should have been licensed on January 1st. You didn't get licensed until July 1st, and so you owed 6 months worth of returns, and there's a 10% penalty for not filing that return. That's usually the penalty that most often is included in a voluntary disclosure analysis. But so that's a good question. Let me find out.
Okay, great. And I also got this attendee's information down for us. So,
okay, thank you.
And that's it for the questions, actually.
Okay. Well, very good. Well, folks, thank you very much. Keep an eye out for our advertising. We'll be doing more of these state-specific webinars in the future, and we look forward. If you have any feedback on how we can make them better, I would love to have that. So, Whitney, if there's no more questions, let's give these folks back their day.
Yep, that's it. Have a good day, everyone.
Thank you. Bye-bye.